The World Bank raises the 2026 global growth forecast to 2.6%. The U.S. consumer prices rise 0.3% in December, and annual inflation holds at 2.7%. And Trump says any country doing business with Iran will face 25% U.S. tariff. You're watching the Economic News Bulletin here on Qnews. I'm Henny Asif, and we'll start off with the global economy as the World Bank raises its 2026 global growth forecast to 2.6%, slightly above earlier predictions, while noting that growth remains uneven and too weak to reduce extreme poverty. Emerging markets outside China are set to grow 3.7%, while China slows to 4.4%. The Eurozone and Japan are projected to expand 0.9% and 0.8% respectively. The chief economist in Gill warned the 2020s could be the weakest decade for global growth since the 1960s, leaving many developing countries at risk of stagnation and joblessness. And on to Europe, the German Federation of Wholesale, Foreign Trade and Services has reported that German wholesalers expect only modest sales growth this year after stagnation in 2025, underscoring deep structural problems in Europe's largest economy. The Federation added that the sector is forecast to grow just 0.7% in 2026, despite the government-backed stimulus. It warned that debt-financed stimulus may boost activity short-term, but will not fix deeper issues such as heavy bureaucracy, high energy costs and labor expenses, raising the risk of insolvencies and job losses. The US bank Citi has stated that British consumers' inflation expectations dipped slightly in December and are likely to weaken further in the coming months. A Citi YouGov survey showed expectations for inflation over the next year easing to 3.6% from 3.7% in November, the lowest since January 2025. Longer-term expectations also slipped to 3.8% from 3.9%. Citi said the decline may not yet be enough to allay concerns among some Bank of England policymakers about persistently high inflation, but expects expectations to soften further as actual inflation falls in the first half of 2026. Moreover, Barclays has shown that British consumers reined in spending in December by the most in almost 5 years, adding to signs of caution ahead of Christmas. Overall card spending fell 1.7% from a year earlier, the steepest drop since early 2021, with spending on essentials declining for an 8th straight month. Separate figures from the British Retail Consortium showed retail sales growth slowed for a 4th month as shoppers delayed purchases until post-Christmas discounts. Barclays said concerns about inflation, tax rises and the economy weighed on households, though it expects easing inflation and interest rates in 2026 to support spending. In Asia, a Tokyo Shoko research survey has shown that Japan's corporate bankruptcies rose to 10,300 in 2025, the highest level since 2013, as rising raw material costs and labor shortages hit businesses. The total was up 2.9% from 2024, marking the fourth consecutive annual increase. Labor shortages caused a record 397 bankruptcies last year. Analysts warned that weak yen, rising interest rates, and trade tensions could create further challenges for companies. A separate government survey showed consumer-focused firms' sentiment fell for the second month in December, with retailers citing higher living costs and travel agencies noting weak tourist inflows from China. In Africa, Nigeria's President Bola Tinubu has announced a $2 billion National Climate Change Fund and a $500 million climate investment platform to support climate-resilient projects and emissions reduction. Oversubscribed green bonds show strong investor interest. The country also signed a trade and investment deal with the UAE covering renewables, digital trade, and climate-smart infrastructure. Nigeria aims for net zero emissions by 2060, while expanding energy access and investing in grid modernization, electric mobility, and green industrialization. The Census Bureau has reported that sales of new U.S. single-family homes fell 0.1% in October to a seasonally adjusted annual rate of 737,000 units, following 2 months of gains. Despite the decline, year-on-year sales were up 18.7%. The median home price fell 8% to $392,300, while inventory remained high at 488,000 units, enough to last 7.9 months. Analysts say lower mortgage rates and Trump's $200 billion Fannie and Freddie bond purchases may help, but long-term yields and inflation keep borrowing costs elevated. The Labour Department said that the Consumer Price Index rose 0.3% in December, in line with forecasts. Annual inflation held at 2.7%. November's reading had been affected by data collection problems during the 43-day shutdown, which forced the Bureau of Labour Statistics to rely on imputed prices, particularly for rents. Excluding food and energy, core CPI increased 0.2% in December and rose 2.6% from a year earlier, unchanged from November. The Fed, which targets 2% inflation using the Personal Consumption Expenditures Index, is expected to keep its benchmark rate in the 3.5% to 3.75% range at its January 27th and 28th meeting. President Donald Trump has welcomed Tuesday's U.S. inflation figures, using them to renew his push for Federal Reserve Chair Jerome Powell to cut interest rates meaningfully. The data showed consumer prices rose in December as distortions from the government shutdown that had suppressed November's inflation unwound, reinforcing expectations that the Fed will likely keep rates unchanged this month. In a related context, the central bank leaders from around the world have voiced rare and joint support for Federal Reserve Chair Jerome Powell after the Trump administration threatened him with a criminal probe. Leaders, including the heads of the ECB, Bank of England and Bank of Canada, said Powell had acted with integrity and warned that political pressure on the Fed would undermine central bank independence, risking higher inflation and market instability. The move follows U.S. President Donald Trump's criticism of Powell and an inquiry linked to his congressional testimony, which Powell has called a pretext to influence interest rates.
With grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee.
JP Morgan Chase CFO Jeremy Barnum has stated that a proposed U.S. cap on credit and interest rates would harm consumers and the wider economy, forcing banks to scale back lending. President Donald Trump last week proposed a one-year cap of 10% on credit card interest rates starting January 20th, unsettling banking stocks. Barnum said such a move would have the opposite effect of what the administration intends, reducing access to credit. Analysts remain skeptical the proposal will advance, noting it would require congressional approval. Industry groups warn a cap would cut credit availability for millions of households and small businesses. U.S. President Donald Trump will attend next week's World Economic Forum in Davos, Switzerland, heading the largest U.S. delegation in the event's history. He will be joined by 5 cabinet secretaries and senior officials. Around 3,000 participants from 130 countries are expected, including 850 CEOs and a record 64 heads of state, with 6 of 7 G7 leaders attending. China will be represented by the Vice Premier, He Lifiang. Trump's visit comes after a virtual address at last year's forum.
If they start killing people like they have in the past, we will get involved. We'll be hitting them very hard where it hurts.
U.S. President Donald Trump has stated that Microsoft will implement major changes this week to prevent higher electricity bills for American consumers linked to data center power use. He added that his administration is working with other technology companies to address rising utility costs and promised updates in the coming weeks, stressing that Americans should not face higher electricity bills because of data centers. We're joined from Washington by the Executive Director of the Global Foreign Policy Center of Washington, Mr. Justin Thomas Russell. Mr. Russell, welcome to Q News. December inflation signal with November CPI distorted by the government shutdown. Does December's 0.3% rise reflect real inflation or just a statistical correction?
Well, it's good to see you, Haney, as always, my friend. You know what? That's going to be a question that a lot of people are going to be asking here, not only in Washington but in Wall Street. My guess is that this is a continuation of a problem that the Trump administration has. Whether we're talking about looking at the numbers for the CPI, or can we trust the numbers from CPI between the cuts that were brought in by DOGE? That is affected even the Bureau of Labor Statistics. There's a lot of questions about the unemployment numbers. So, when we see the CPI, when we see inflation numbers, the question is, can they be trusted? Number one, were they analyzed correctly? 2, and 3, this is a bigger problem for Trump because in a time that he's saying that, everything is great with the economy, we're seeing signs that everything is not great with the economy, and that's going to be a problem for Donald Trump moving into midterms coming up in November.
Mm-hmm. Well, the core CPI held at 2.6%. Well, the Fed targets 2% via the PCE. Does this gap mean the Fed is closer to or further from its inflation goal than it appears?
You see, that's the big question that I have right now, Haney, is the idea that, we're seeing, other than energy prices, gasoline, and I know that they're going back and forth on the consumer food pricing, kind of remaining the same. But other than those two, prices went up, and I think that this kind of draws it. The question comes up to, we're seeing them, although inching slowly, they're still increasing, and now the Fed's going to have to deal with this, with the question of, how do we look at interest rates. Do I think that this is enough that it will force Chairman Powell and the Fed to cut rates, let alone cut them drastically? No. Jerome Powell's very practical. He's very risk adverse. But he is going to feel a lot of heat from Donald Trump and the administration to do so. But there, to Jerome Powell's credit, there's not enough evidence to justify making this big of a financial, rate change based on numbers that nobody's 100% confident.
Well, the Fed is definitely feeling the heat of Trump's pressure. President Trump called for meaningful rate cuts. How should the Fed then weigh the political pressure against inflation data when making decisions?
Look, traditionally, whether, no matter who the Fed chair is, the Fed chairs have traditionally maneuvered inside the political arena very independently. This goes all the way back to Alan Greenspan. Alan Greenspan never, bowed to political pressure. He did what was required and what was fiscally responsible in the best interest of the financial stability of the nation. Jerome Powell is no different. Jerome Powell, I would say, is even more so risk adverse. He is not going to kneel at the political throne just to make the president happy, knowing that he's got a responsibility and a fiduciary responsibility at that to maintain the economic stability and even promote the economic growth of the largest economy in the world. So, is Trump going to be a pain in Jerome Powell's side? Absolutely. Is Jerome Powell going to, bow to his wishes? No, we saw that in his message last night, directed at him after the DOJ announced that they were investigating Jerome Powell for financial misappropriations in the rebuilding of headquarters. It's not a Jerome Powell function.
What about inflation? Do you see the rent imputation and the lagging shelter costs be keeping core inflation artificially high in the first quarter of 2026?
Wow, Haney, that's the $1 million question. Again, we're in first quarter 26. We're dealing with a little bit of an artificially kind of enhanced economic quagmire coming out of the last couple of quarters of 2025. I really don't have a good answer for that, Haney, and here's why is because if we look at the cost of the CPI, which is moving up, the inflation indicators are moving up. However, we're seeing mixed job numbers, which are questionable as due to the comments I made earlier on the Bureau of Labor Statistics. We're starting to see an economy that's kind of got an identity crisis. Is the economy strong? Well, if you look at the markets are tagging the highest markets in history. But if you look at the ability of American families to be able to sustain themselves long term, being able to keep a roof over their head, being able to put food on the table, healthcare costs are going to be a big issue coming up here in the next few months. These are numbers that indicate don't be fooled by the stock market, because the stock market doesn't indicate the strength or weakness of the economy. But we can't really look at the other numbers that say the strength or the weakness in the economy. So it's a Zen master will see kind of situation.
Well, we heard President Trump suggesting a 10% cap on credit card rates. Would it restrict lending for subprime borrowers, push demand to BNPL or predatory lenders, and threaten the major banks' profitability?
Look, I've talked to a couple of economists here stateside on this subject, Haney, and you know what? There's not really there is a consensus. When you talk about Trump's proposal like capping, for a president that is the the market economy president, the greatest market economy president in the world. He's putting together some really socialistic, market restricted type policies. When the federal government starts saying you're going to cap interest rates, these are, banks are businesses. You shop around the interest rates. If I want to go get a credit card and I don't want to pay 27%, I go to another bank that will issue me the credit card and get a lower rate if I can. They are introductory rates. There's all kinds of things. What this does is this makes it look like that the federal government, Donald Trump, Scott Bessent, is starting to try and puppeteer, if you will, the economy to the administration's political benefit. And the banks aren't going to hold up. They have investors that they have to answer to, and there's no real indication that capping it at 10%, that's not going to make costs. That's not going to make prices cheaper at the supermarket. It's not going to reduce the cost of housing. All this is going to do is just put a little bit of a Band-Aid with salt under it on a wound that needs to be addressed.
Mm-hmm. From Washington, that was the Executive Director of the Global Foreign Policy Center of Washington, Mr. Justin Thomas Russell. Mr. Russell, thank you very much for your insights. And now we move on to the latest in the MENA region. The Minister of Planning, Rania Mashad, has announced that Egypt will receive €1 billion from the European Union next Thursday, the second installment of a €5 billion financial support package. The third tranche of the €1.5 billion is scheduled for mid-2026, with the fourth of €1.5 billion expected by the year's end. The package, part of a broader €7.4 billion EU commitment, including concessional loans, aims to support Egypt's economy and strategic cooperation with the bloc. Egypt received the first €1 billion tranche in December 2024, and the remaining funds will carry a repayment period of up to 35 years. US President Donald Trump has announced on Truth Social that any country doing business with Iran will face a 25% tariff on all trade with the United States, calling the order final and conclusive. Iran is already under broad international sanctions from the US, UN, and EU, leaving trading partners at risk of economic penalties. Brazil ran a $2.9 billion trade surplus with Iran in 2025, raising the risk of US tariffs after President Trump warned that countries trading with Iran could face a 25% tariff. Brazilian exports to Iran were dominated by corn, 68%, and soybeans, about 19%, with Iran importing 9.1 million tons of Brazilian corn, nearly as much as Egypt and China combined. Imports from Iran totaled about $85 million, mainly fertilizers, fruits, and nuts. And for further analysis, we're joined from London by the political and economic advisor, Mr. Babak Emamian. Mr. Emamian, welcome to Q News. How might President Trump's threat of a 25% tariff on countries trading with Iran affect China, given Beijing's historical and current trade with Tehran?
Thank you for your great question. This is a very great strategic move by President Trump, because on one hand, he's denying the Iran regime security forces an income that they desperately need, that money coming from China to support their operation. On the other hand, it's also slowing the Chinese economy, because China, about 15% of its oil imports are from Iran at a discounted price. Now they're going to lose that. They either will pay 25% extra on tariffs, which already they pay 35% tariff to US. So that would take it to 60% tariff, and it would really hurt the manufacturing. Or they continue buying from Iran. I think they will not do so. They will not buy from Iran. Most probably there'll be some buying on the black market from Iran, but not most of it. But it's a great move, and it's been a bad week for China. They've lost Venezuela, and now they've lost Iran.
Well, do you see this reigniting tensions with the US-China relations, or do you think China will just calmly find a way around it?
Well, that's again a great word you use, tension. What is the tension now? Right now is economic competition, rivalry. Would that become, would it turn into a military conflict? I doubt it. I think it will remain an economic rivalry, pressure. And at the other hand, if you look at it, the moral is on the side of President Trump. This regime just killed 12,000 people, according to most outlets, in the last 2 days. And would Chinese government want to be associated with such a barbaric regime, even though they make some money from them? So there is that issue of, morality, civilization, humanity. So that all comes into play.
Well, China does classify Iran as a comprehensive strategic partner, Venezuela as well as a strategic partner in all circumstances. How do these distinctions then shape Beijing's likely response to US pressure on the Iran-related trade?
Well, again, we go back to the previous discussion. We really have to question the morality of the Chinese government. Is that how they want to be seen, as immoral people, that they only deal, or they enjoy dealing with oppressive regimes, with regimes that kill their own people, destroy their own people? And perhaps, I'm not here to advise what the Chinese should do, but maybe there should be a discussion, or maybe they should discuss within themselves, where is the Chinese are a great culture. They're old, ancient culture. So why would they want to pursue trade with such nations again and have a bad name? They are known a great culture. They're known for trading nation and manufacturing nations. They could afford to lose a bit of profit or a bit of trade, but then behave more morally.
Well, given that China has reduced the imports from Iran significantly in major state-owned oil companies that haven't dealt with Tehran since 2022, how feasible is it then for the US to impose and enforce such tariffs effectively?
Well, first of all, this is according to the Chinese, so we don't know if they've really done it. And there are so many ways they could get around getting supplies from Iran. So knowing President Trump, he would play the same game. He would just say, I have my own evidence that you're buying from Iran, so I'm going to impose that 25% tariffs. And so it's very much how the President Trump wants to play this. It's not according to evidence or a court of law, but it just if President Trump sees it is not getting anywhere, he would impose that 25%. And they know that's the type of leader President Trump is.
Well, one final question. With much of Iran's oil exports to China then handled through small independent refiners outside official records, how might these transactions complicate the US enforcement of the new tariffs?
Well, right now, we know for a fact that the entire Iranian security system has been infiltrated hugely by the Americans. And they have been there for a very long time. So to find out how trades are done is not that difficult for them. The question is, when do they want to stop these trades? Because so far, this is a president who is pro-trade, pro-prosperity. But if it wants to stop the trade, they could do it. They have inside people who could stop these trades.
From London, that was the political and economic advisor, Mr. Babaki Mamian. Mr. Mamian, thank you very much for joining us. And by this, we come to the end of our economic news bulletin. But before we wrap up, here's a quick recap of what we've been covering. The World Bank raises the 2026 global growth forecast to 2.6%. U.S. consumer prices rise 0.3% in December, and the annual inflation holds at 2.7%. And Trump says any country doing business with Iran will face 25% U.S. tariff. These are all the economic and financial news we have for now. I'm Henny Safer. Thank you for joining us.